We're diving into the paradox facing, well, pretty much every ambitious Canadian tech founder.
Right.
This pressure to follow the classic Silicon Valley playbook, hyper growth, quick VC raises.
But that model, it's really built on this assumption of speed trading dilution for market share,
And it assumes a smooth path to product market fit.
which for most founders, especially if you're outside the big tech hubs, is, let's be honest, it's a fantasy.
So conventional wisdom says build the product, raise the pre-seed, and just hit the gas. But what happens when that starting line is, completely blocked?
It often is.
Our deep dive today looks at the sources detailing a very different playbook, the non-traditional and maybe smarter alternative that starts with building cash flow, not just commitment.
And to really get why that alternative is so essential, you just have to look at the numbers.
Okay.
Institutional VC funding is a brutal game. Our sources cite success rates, and this is combining pre-seed and seed rounds, at less than 1%.
Wait, less than 1%?
Less than 1% for founders trying to get that institutional money.
That's genuinely shocking. I mean, it feels like the door is almost welded shut. It's forcing founders to bet their entire runway on this incredibly long shot.
Well, and that number is focused heavily on the institutional path, which is exactly why so many founders feel this pressure cooker effect. And it's getting worse. The market is tightening. Look at just the first half of 2025 in Canada.
What did we see?
We saw a 16% decrease in investment dollars and a 28% drop in the sheer number of deals. Capital's just drying up.
That's more than just a chill. That is a deep freeze.
It is. And the money that is available, it comes with far, far higher expectations.
It's no more funding, just a pitch deck.
Not anymore. Investors are demanding maturity. Sources are showing that founders are now expected to demonstrate monthly recurring revenue, specifically in the range of, say, $5,000 to $10,000.
Wow.
Or have concrete letters of intent from real, confirmed customers before they'll even consider writing a seed check.
So if the bar is that high, just to get started, the standard VC-backed model, the one that encourages you to burn cash for 2 years, hoping to find product market fit.
It becomes incredibly risky.
It's high risk, high reward, but the risk side is just, it's massively weighted toward failure.
Exactly. And we pulled some fascinating comparative data on this.
Yeah.
That high-growth VC path.
Yeah.
It's all built on speed, but the data shows only about 20% of VC-backed companies actually survive for 10 years.
And what about for the founder? If the company fails to become a unicorn or just struggles for a decade, the individual's outcome is even worse, right?
It's so much worse. It's sobering, really. Following that path gives the founder a staggering 90% chance.
90.
A 90% chance of walking away with no meaningful financial return in the end.
So you could build a viable company but still get nothing.
You could.
Wow.
Because of the dilution, the preference stacks you need for those early investments, you often trade away your entire personal financial outcome.
A 90% chance of nothing. That completely reframes the risk calculation.
It has to.
Okay, now contrast that with the bootstrap path. What does the data say there?
The data shows a company's long-term survival rate is almost double. It's at 38%.
Okay, that's a big jump.
And for the individual founder, that risk disparity completely flips the script.
Oh, so?
The bootstrapped founder's odds of actually achieving a real financial win, they jump to between 50% and 75%.
50 to 75%.
Yeah. And that huge difference in personal outcome is why this contract-first playbook is no longer some niche idea. For a lot of people, it's becoming the rational choice for survival and, for control.
When you face a 90% chance of walking away empty-handed, ambition shifts from how fast can I grow to how can I survive and actually guarantee a payout. Okay, let's unpack this alternative strategy. Bootstrapping through contracts and services.
This strategy is so often misunderstood. People think it's just settling for a lifestyle business.
But it's not.
It's simply not true. Our sources indicate that a really substantial minority, we're talking around 20% to 30% of successful early-stage tech startups initially rely on contracts to sustain themselves.
Before pivoting to their product.
Before pivoting. They're essentially using paying customers as their first non-dilutive investors.
That makes so much sense.
And this bridge strategy, it provides 3 crucial benefits that directly deal with the risks we just talked about.
Okay, what's number 1?
First, and most critical, is revenue stability. We know from CB Insights data that the top reason startups fail is lack of cash flow.
Right.
Contracting provides predictable cash flow right out of the gate.
Can you give us a tangible example? Like, what does this actually look like for a software founder?
Sure. Imagine a founder in the Toronto-Waterloo corridor.
Mhm.
She has a great idea for, say, an AI-powered compliance tool for financial services.
Okay.
Instead of spending 6 months pitching VCs on a deck, burning through her savings to build a buggy MVP, she secures a consulting contract with a large regional bank
To do what specifically?
to handle a specific complex data integration task, something in her wheelhouse.
When she gets paid for that work immediately.
Yes, that fixed, reliable payment. That's her cash flow machine,
Okay.
which brings up the second benefit, credibility.
Ah, the logo.
The logo, landing that large client, a major bank, an insurer, a government agency, it signals instant credibility. That logo on your slide deck is validation that future customers and investors respect far more than some unproven prototype.
That's a powerful point. Investors who demand traction are getting that traction validated by a massive, risk-averse enterprise.
Exactly. And the third benefit might be the most strategic one. It's a funded learning curve.
What do you mean by that?
Instead of guessing what the market needs, you use those enterprise projects to surface the actual detailed requirements of your ideal customer. You're effectively funding your own R&D with customer revenue
Until you see the repeatable pattern.
until the patterns emerge and your proprietary product is ready.
Okay, here's where it gets really interesting. Because you're trading the speed of the product-first model for stability and for learning. So, looking at the comparative timelines, what does that trade-off look like in practice?
The difference in timing really reveals the shift in risk. A product-first startup, they're seeking seed funding immediately,
Yep.
year one,
The race to market.
to race to market. The contract-first startup defers that huge equity event until year two.
And in the meantime,
In the meantime, they use that services revenue to validate demand, to refine the product concept, and to drastically reduce their early dilution.
so they're preserving their equity stake for much, much longer.
Absolutely. The contract-first approach prioritizes using revenue to fund operations.
And they launch their own product later.
Much later. Typically in year three, after they've refined those patterns they found through their consulting work, the product-first company they've already launched by year two.
But at what cost?
But likely at the cost of significant early dilution and, potentially with an unvalidated product.
The core risk of the contract-first model, of course, is getting locked in.
Right, becoming a consulting shop.
Becoming a highly profitable consulting shop instead of a scalable SaaS company. But given the brutal success rates of the VC route, slow and controlled suddenly looks incredibly rational.
And this alternative playbook is especially potent in Canada. And that's partly because of some unique institutional advantages we have that specifically favor these revenue-generating small businesses.
Which helps them maximize those early profits.
Exactly.
Let's talk about the tax structure. How does that play a role?
Well, the foundational difference is something called the small business deduction, or SBD.
Okay.
So Canada's standard corporate tax rate, it's around 26% combined. It's competitive. But the SBD is this massive institutional advantage that bootstrapped founders really must leverage.
And what does it do?
It grants Canadian-controlled private corporations the biggest tax break in the entire G7.
The biggest in the G7.
The biggest. You're talking about a federal rate of just 9% on the first $500,000 of profit.
9%.
And when you factor in provincial rates, that combined tax rate drops down dramatically. It often sits somewhere between 11% and 15%.
That's incredible. It means a founder running a cash flow positive service business is penalized way less. They get to reinvest those early profits at a far higher margin than a similar company in, say, California.
It directly incentivizes the exact behavior we're discussing: profitability and lower tax burdens. They get to keep so much more of that hard-earned services revenue to fund the eventual product launch.
And the advantages don't just stop at tax, they extend to talent too. And this is partly thanks to some geopolitical factors south of the border.
That's right. The U.S. H-1B visa system, which is the main path for skilled foreign tech workers, it's becoming increasingly hostile and astronomically expensive.
I've heard about this.
Yeah, analysts point to ever-increasing fees, sometimes hitting six figures, which are just unsustainable for smaller U.S. startups.
That's devastating, especially when you consider how many U.S. startups are founded by immigrants.
Over $500 million U.S. startups have at least one immigrant co-founder.
Yeah.
So the U.S. is essentially creating this massive talent drain.
A drain that Canada is actively capitalizing on.
Absolutely. Canada is aggressively recruiting this skilled talent. We're leveraging our high education levels, streamlined immigration, and this is crucial, those generous R&D tax credits.
We mentioned R&D tax credits earlier. Let's talk specifically about SR&ED. What's the unique advantage there for a bootstrapped company?
What's fascinating here is that the Scientific Research and Experimental Development Tax Credit, SR&D, is non-dilutive.
Not dilutive.
It essentially refunds you a percentage of your R&D, payroll, and costs. So the government is helping you fund innovation, helping you hire for those complex contracts.
Without the founder having to give up a single point of equity.
Not one point. This U.S. policy failure is, frankly, quickly becoming the main competitive edge for Canada. It's fueling the local talent pool we need to execute these complex, high-margin service contracts.
So what does this all mean? It means the successful Canadian tech founder has a new blueprint, one that really defies the old VC dogma.
Right.
Start by generating immediate revenue and credibility through contracts. Use Canadian tax incentives like the SBD and SR&ED to maximize that early profit and capitalize on the global tech talent that's migrating north.
The slower, more controlled path, trading speed for survival and dilution for profit, it's not the route of the small thinker.
No.
It's the most rational, high-odds choice for ambitious Canadian founders trying to navigate a really tough funding market.
And that focus on immediate profitability is so key. If you are operating a bootstrapped company, the sources show you are 3 times more likely to hit profitability within 3 years than your VC-backed counterparts.
3 times more likely. Which leads to a final thought for you to consider.
Okay.
Given all those facts, should Canadian investors and founders, should they stop viewing early profitability as a sign of a lack of ambition, as a sign the company isn't thinking big enough,
And start seeing it as something else?
and instead start seeing it as a sign of strategic, calculated strength and just, superior financial management?